Welcome to the Investor Edge. Today, we are dissecting Alphabet's fourth quarter results for fiscal year 2025. Here is the shocker. Alphabet just became the first company in history to cross $400 billion in annual revenue. Yet the stock sold off in extended trading. Why? Because management just dropped a capital expenditure bombshell. They plan to spend up to $185 billion in 2026 alone.
That is a staggering number, Mark. To put that in perspective, they are planning to spend nearly double what they spent just last year. Investors are asking if Alphabet is building a golden moat or walking into a capital expenditure trap.
Exactly. Today we will break down why their cloud business is exploding at 48% growth, but also why their free cash flow actually dropped despite record sales.
We will also look at the hidden costs buried in their report and the technical levels you need to watch. Let's dive in.
Let's look at the hard data. For the fourth quarter, Alphabet reported consolidated revenue of $113.83 billion. That is an 18% increase year over year, beating analyst estimates of $111.43 billion.
And their earnings per share, or EPS, which is the portion of a company's profit allocated to each outstanding share, came in at $2.82. That beat the forecasted $2.64.
The segments are where the story gets interesting. Google Search grew nearly 17% to $63 billion. But Google Cloud was the real star. It grew 48% to $17.66 billion.
Let me pause there. A 48% growth rate for a business that large is incredible. For context, they are now growing faster than Microsoft Azure. Even better for bulls, cloud margins hit 30.1%. Just a year ago, that margin was only 17.5%.
However, profitability had some noise. Their operating margin, which shows how much profit a company makes on a dollar of sales after paying for variable costs, was 31.6%. That was actually down slightly from 32.1% last year.
That dip was partly due to a $2.1 billion compensation charge for Waymo, their autonomous driving unit. And we have to talk about GAAP versus non-GAAP. GAAP stands for Generally Accepted Accounting Principles. It is the standard way companies must report. Alphabet's GAAP net income was $34.46 billion. But if you add back stock-based compensation and restructuring, their adjusted income is over $42 billion.
That is a 24% difference. Usually, a gap wider than 15% is a signal for investors to look closer at aggressive accounting. This brings us to our most important segment, the discrepancies. What management says versus what the numbers actually show.
Here's where it gets interesting. The first major red flag is the efficiency myth.
Right. On the earnings call, CEO Sundar Pichai said, "As we scale, we are getting dramatically more efficient," and claimed they lowered Gemini serving costs by 78%.
But look at the data. While software might be efficient, physical costs are skyrocketing. Depreciation, which is the way a company accounts for the wear and tear on its hardware, rose 38% to nearly $6 billion. Other costs of revenue rose 13%. Essentially, the software is getting cheaper to run, but the hardware and energy to power it are becoming massive financial burdens.
The second discrepancy is what I call the search expansion paradox. Management repeatedly called this an expansionary moment for search. They say AI is making people search more.
But check the Google Network segment. That revenue actually fell 1.6%. So while search is growing, it seems to be doing so by eating the rest of the web. Alphabet is capturing more of the pie, but the pie of third-party websites they serve ads on is actually shrinking.
The third and biggest discrepancy is the capital expenditure moat. Management frames the $185 billion spending plan for 2026 as a sign of massive demand.
But the numbers show a radical shift in the business model. In the fourth quarter of 2024, Alphabet had $24.8 billion in free cash flow. This year, despite $17 billion in extra revenue, free cash flow actually dropped to $24.6 billion.
That is the CapEx trap. Alphabet used to be a capital-light software company with massive cash conversion. Now, they have to spend nearly $1 in capital for every $2 in new revenue just to stay competitive. They are starting to look less like a software company and more like a high-tech utility. So, how do we trade or invest in this? Let's start with the short-term framework for traders.
If you are a short-term trader, the technicals are a bit mixed. The stock is around $333. We see a rising wedge pattern, which technically can be a bearish signal.
Key levels to watch. Support is at $328. If it breaks that, the 50-day simple moving average, or SMA, is at $321.70. Resistance is at the all-time high of $344.
The RSI, or Relative Strength Index, which measures the speed and change of price movements, is at 54.8. That is neutral. It means the stock isn't overbought or oversold right now. If it fails to clear $350 soon, we could see a correction toward $300.
Now for the long-term thesis. Let's look at the bull case. If you believe Alphabet's full-stack AI, meaning their own chips, their own models, and their deal to power Apple's Siri, is an unbeatable moat, here is the math.
If Google Cloud maintains 35% growth through 2027 and the Apple partnership adds $15 billion in yearly revenue, earnings could hit $14.50 per share by 2028. At a 29 times forward price-to-earnings ratio, that gives you a target of $420. That's a 26% return.
But what about the bear case? If you believe the AI race is a zero-sum game where everyone spends billions just to stay in the same place, the risks are real.
If the Department of Justice, or DOJ, forces a breakup of their ad business, or if conversational bots like OpenAI start stealing high-margin, commercial-intent searches, the math changes. If growth slows to 6% and the market views them as a low cash flow utility, the stock could derate to a 20 times multiple. That takes the price down to $265.
For a growth investor, that 48% cloud growth makes the stock look undervalued relative to its momentum. But for a value investor, you might want to wait for a pullback to $300 to get a better margin of safety. The key takeaway today is that Alphabet is a company in transition. They are winning the revenue war, but paying a massive price in capital to do so.
It is a hold or watch for most. The $240 billion cloud backlog is a huge safety net, but that $185 billion spending plan for next year is a heavy weight to carry.
That wraps up today's deep dive on Alphabet, ticker GOOGL. If you found this analysis helpful, please like the video, subscribe to The Investor Edge, leave us a 5-star review, share this episode with a fellow investor, and follow us on Spotify, YouTube, and X. If you want us to cover a specific stock, please email us at opalfinancial1@gmail.com. We read every message. We appreciate your support, and that means a lot for us.
As always, this episode is for educational purposes only. This is not financial advice or a recommendation to buy, sell, or hold any security. We're not registered investment advisors. We don't know your personal financial situation. All investments carry risk, including loss of principal. Do your own due diligence and consult a licensed financial advisor before making any investment decisions. This is The Investor Edge, produced by Opal Financial, LLC. Please reach out to opalfinancial1@gmail.com for any questions you may have. Thanks for watching.